Anybody got any cards for me? There we go. I went through once this afternoon, making a little bit of progress. Jordan. Meet you. Jordan, what company are you working on this semester?
Albemarle.
Thank you. Yeah. Did I say that right? Nice to meet you.
But you just.
I think I forgot mine at home.
Okay.
Yeah, sorry.
Oh, then you're in the clear. Did you say something?
But you can just call me Sylvia.
Just call you Sylvia, okay, so preferred name, Sylvia, okay, nice to meet you. Thank you. And teach me how to say this.
Koshi.
Koshik? Nice to meet you.
Nice to meet you.
And as these come in, I'm trying to write down on the back what companies everybody's working on. Koshik, what company are you working on this semester?
It's community.
What was that? Did you pick one for your research?
Yeah, I picked one.
Oh, okay. While you're looking that up, Sylvia, what's Clorox? Ticker CL,
COX.
CLX. Gotcha. And Jordan, you said what?
Albemarle, ALB,
ALB, Albemarle.
or Albemarle.
I don't know that. What do they do?
Chemicals manufacturing.
Okay. Okay, and let's see, Apom, did I say that right?
Mm-hmm.
What are you working on this semester?
Chevron.
Chevron. Ticker, is it just C? City. CV,
CVX.
CVX. So I saw you almost play for Man City,
United.
Man United, man, and you ended up in my class. Of all the paths not taken.
Yeah, I was back in 2007, under 17. Yeah.
2007, that's cool, that's a great story. Isaac, what are you working on? Zane?
I've got
Right here.
S&P
It
Global.
was, oh no, I just drew a blank. What was it? I just
Bill, how
had it in
about
my
you?
head.
AFLAC?
Aflac?
Yeah.
AFL?
It was Sherwin-Williams was mine. And it's SHW.
Sherwin Williams. Yes. Bill Aflac. I think I don't remember what module it is. But when we get into foreign currency translations, that's gonna be big for Aflac.
Okay.
So just be mindful of that. So you run track, what distance?
100 kilometers.
100 and the 200, which is your preferred race.
200.
But how fast do you run a 200?
25.
25. That's moving. That is moving. So next month I will compete in the Masters track and field championships up in Chicago.
Oh.
I'll be competing in a 4x800 meter relay. So when you get to be this old, the competition thins out a lot. Which my wife will vouch for that, because I get a big eye roll out of her when I read the measures. The challenge is, A, stay healthy until you're close to 50. And then be able to run somewhere, you gotta be able to run an 800, if you can run it around 215. And then you gotta recruit 4 guys who can all do that. If you can accomplish those 4 things, you can compete for national title. So we're gonna get compete, but that 25, that is, wow, that's good. Ryan. Ryan, Jace, what are you working on, Jace?
Target.
Target, is that TGT?
Yes.
Okay, I think Target's actually in some of the examples that our authors give in the book, so you might be able to look out for that. That'll be helpful. Okay, Argyle. Stay at that top, probably really messed that one up. Here, okay. Riley. Okay. Rajendra. What are you working on this semester, Rajendra?
Yeah, you check this again.
Okay, did I say your name right?
Yes.
Okay, nice to meet you.
I think you have a chat on Zoom.
Oh,
I think you asked his company, I think it was Isaac on the Zoom call.
oh, okay, great. S&P Global, I did, great, gotcha, S&P Global. Okay, I'll write that down. Or I might have to ask you again after I circle back. Andrew Ramirez,
Realty income.
Realty Income. Okay, that's a REIT, right?
Yeah, real estate.
And that's one of the most, is the ticker O?
Yep.
Yeah, that's one of the most successful REITs in the company. They have a very compelling story, but REIT financials can be lower there. So, I would encourage you to get in there and read that 10K sooner rather than later, okay, so that you're have a good understanding of any of the accounting policies. Alex, what are you working on? Performance. MCK?
NKC.
MKC. License? Okay. Ian. Elizabeth. Ira Gushers, Next Energy, right?
Next era.
Next Era, got you. And Jessica. Pepsi. Pepsi, and that's just P, right? PEP. PEP. Okay, this helps me as we go through the semester. I'll try to be mindful of what they're working on and have an opportunity to draw an immediate connection to any of those companies while we're going through some of the technical aspects of the accounting and all. Pointed out. So, okay, tonight we have module 4. I'm gonna lecture on module 4. It's all about credit analysis, which is basically the exact same thing, or very similar. Think of it as the same thing as equity analysis. So we have all trained ourselves or put ourselves in the position of an analyst working for a mutual fund company or a portfolio manager. We're analyzing companies as if we're a potential investor and we might want to buy the stock. Tonight, we're going to be talking about the publicly traded debt markets. So just like you can buy the stock of a company, Pepsi or Clorox, or pick any of the ones that we just talked about, they also have publicly traded debt. And when they issue debt in the public markets, that's exactly what it sounds like. They're borrowing money, and they borrow money. Everybody in this room represents the global supply of investors. Then I, as a publicly traded company, if I'm Pepsi, I can borrow money from you. And that transaction is initiated through large Wall Street banks. And they divide up these debt offerings in increments of typically $1,000, and that's called a bond. So in increments of $1,000, you can buy a bond, or the basic transaction is you give me $1,000 and I give you back a piece of paper that is a bond, and on that bond it has it's an IOU. It says I owe you $1,000 at the end of 10 years, and between now and then I'm going to pay you X% on that money. Call it 4%, probably closer to 6 or 7% today. And then at the end of the 10-year period, between now and 10 years, you get interest payments. And at the end of that 10-year period, you get your $1,000 back. And that's as simple as I can make that transaction. So when we go through the slide deck tonight, I'm gonna point out all different kinds of debt offerings and debt instruments and the rules and conditions and terms and covenants that they have associated with them that are all dependent on a company's issuer credit quality. But at the end of the day, we're just talking about debt. And our finance system has gotten so sophisticated that public debt, that bond offering, that piece of paper that I give you when you give me $1,000, you can trade it amongst yourselves. So you don't have to wait till the end of that 10-year period to cash in your bond. You can just sell it to somebody else. Get your money back and walk away. Now, there's some risk associated with that, and I'll touch on the nuances of it, but that's module 4. Before I jump into the slideshow, let's talk about the exam. At the end of module 4, we will have completed the first 25% of this class. Then I will open the exam window on the My Business Courses website. And that window is going to be open for 2 weeks. So after class tonight, I'll go out, open the exam window. I'll send everybody an announcement. Say the window's open from Tuesday, February 6th through probably the 20th. And then at any point during that period of time, you can log into My Business Course website and take the exam. So you'll recall when I set this up from night 1, I mentioned this is an open book, open note exam. If you're taking it by yourself at any point in that window, there's no proctor, nobody's monitoring you. So how do you make an open book, open note exam challenging? How do you, there's gotta be some proxy for how well you're internalizing this material. So we do that by making it timed. So if your mindset is that you're gonna start that exam and you'll have time to look up all these answers, you'll run out of time and you'll fail. You have, it's a 40 question exam, multiple choice, some problem solving, 40 questions. You'll have time to look up probably 10 of them. And the rest you just kind of need to know. You need to move through pretty consistently. So go through all your material, slide deck, book, star your reference pages, some of the material that might have cropped up on some of the individual homework that was a little bit challenging for you. So you have a quick and easy lookup reference, and you should do fine. The other challenging aspect of the exam is that it's not the same for everybody. Again, the textbook authors, with the help of technology, they have the opportunity to make these questions dynamic. So no 2 of you will get the exact same question. Then you won't get them in the same order. So you won't be able to take the test together or copy out one another, which you wouldn't want to do anyway, because if there is a curve, you're only harming yourself. Okay, questions on the exam, questions on homework, any other aspect of the class so far? Okay, we missed last week. Did everybody navigate out there to the YouTube page, all right, find module 3, any questions about that material, Elizabeth?
So when we're watching those for just ourselves and we're not here, we are looking for just regular module 3, because I noticed you had like module 3 and then you had module 3. Like, I believe that was your like graduate class. So it was like, there was like multiples of module 3.
Yeah, I'm not.
I think it was
I'm
like
not the-
module 3 with
I'm
us,
not
and then there's
I'm
module
not
3
best at
finance,
I
organizing that.
think,
500 and something, or
I think-
5,000.
yeah, I think you did it by the year.
Was it by the year? I thought it was, mine popped up as the module, but then it was module 1 for this, and then like, there was multiples of each one.
So if you look at it like.
Oh,
Yeah, it says like finance 5561, so I would assume,
2020.
Here's our site, so.
I was just looking at like, how it's like module.
Oh, yeah. So
Yeah, it looks like I have 5 of them out there. And the most recent one, it was 2020, so September 11th from last semester. So this is the one I would refer you to.
Okay, well, I was gonna watch that one.
It's the
Well, it
most
said
recent
finance
date.
556, so I wasn't sure if that was the graduate class, so if that was,
It is the graduate class.
okay,
This is a blended class.
okay.
Fin 556 is together with Fin 419. Everybody gets the exact same letters. There's a different rubric. I divide all the students in 419 and the students in 5516, and I keep track of all the scores and grades separately. So if I need a curve, I will apply that separately. And I also have a different rubric for grading the final project. There's a I guess stiffer standard for the master students. So I think of this class as 5561, but it's also 419, and then the labeling could be better on that. So thank you for drawing my attention.
So we just watched the most recent video.
Just watch the most recent video, and I'll take that as a task to get out there and clean that up next time. Let's get it over with. But in the meantime, yeah, just watch the most recent. Good question. One of these buttons gets rid of all those red lines I just drew. Stamp, spotlight, erasure. Okay. Let's talk about mod. Okay, supply and demand for credit. Okay. That basic transaction that I opened the class with, where these companies that we're all working on borrow money. We'll get to the bond market, but our authors first point out 5 or 6 different ways that we can engage the broader credit market. So when you look at the balance sheet, you're going to see trade creditors. That's typically accounts payable when we buy inventory. Last time we were all together, we spent 15 minutes talking about Apple's cash conversion cycle and just how powerful Apple was when it comes to negotiating with a lot of their suppliers. They'll have the inventory shipped to them today, and they'll pay them in 90 days or in 180 days. Well, that's recorded on their balance sheet as an accounts payable. That means money owed. And when we owe money to an inventory provider, we think of that as trade creditors. So that's one of our inventory suppliers that's allowing us to owe them, and that liability shows up on the balance sheet as a payment that we'll ultimately have to make in the future. Banks can be a source of capital, private debt investors. Private debt investors, that area of the market was just exploded. Last year, we saw Synergy Bank, was it Synergy? It's not quite right, but
SVB,
SVB, thank you, First Trust,
First Trust,
and there was another smaller one,
Republic.
First Republic, thank you. 3 banks failed, and we just got 2 of them, and the third one, somebody in here will come up with the third one. They failed because interest rates were rising so significantly, and they had a very large proportion of debt on their balance sheets that had to be repriced. And when I say repriced, that means when interest rates go up, the price of bonds goes down. So those were listed as assets on their balance sheet. And the decline in the value of those assets created liquidity problems for the bank. So the banks ultimately had to run on the bank and they failed. So that is not a unique situation to just those three banks. It's affected every bank in the country to a greater or lesser degree. But the cumulative effect has caused public lending standards to be tightened significantly. That whole market is an order of magnitude smaller today than say it was 2 or 3 years ago. That has created a new market. It's always been there, but a private market for investors who are willing to come in and loan their money to companies who no longer have access to a bank. So it can be and has been a very profitable place for investors to play. Keep in mind, it adds a lot of risk. Any company that's pursuing loans in the private market is not pursuing them in the public markets. And typically that's going to require them to pay higher interest rates because they can't get a loan from typical banks and public creditors. Okay, our authors walk us through the typical needs of debt financing, and I won't dwell on this very long, but I want to make sure that everybody in this class has a good understanding of just how important it is to understand what your borrowings are being used for. So one of the assignments coming out of Module 4 is to familiarize yourself with the balance sheets of your individual companies. So take that company that you picked, look at the balance sheet, analyze the debt. Where is it coming from and what's it being used for? And you're going to see a concept that our authors call evergreen debt. I want you to understand what your company's plan is for paying back the debt that they have on their balance sheet. So let's look at it. Sylvia, let's look at Clorox. Let's see if we can turn this into a real example here. Let's go over to Yahoo Finance. Type in COX. So now we're looking at Clorox company and we have financials right here. And we'll click on the balance sheet.
You share your screen, please.
Thank you, yes. There we go. Okay. So now we're looking at. Okay, there we go. Now, so Sylvia, we're looking at real numbers here. So your job with Clorox is to understand that they have what looks like, these are probably in millions, so $5.9 billion worth of assets on their balance sheet. Then they have total liabilities of $5.5 billion for total equity of 388,000. So Clorox is what we would call very levered. They have a lot of debt on their balance sheet. So most of those assets that you see here have been bought with borrowed money. That's good and bad. Borrowed money makes the company risky. But if the management team can execute with all that debt on their books, then the return on equity is going to be extremely high. So it represents kind of a levered play on the operating margin of their business. Let's click into this total liabilities number and we can see a little bit of a breakout. We have 1.9 billion in current liabilities. And then 3.6 billion in non-current liabilities. So this is probably their publicly traded debt. If you look at their 10K filing, you're gonna find a big section on that debt, and it's gonna give you a table showing every time that they've ever borrowed from the public markets and when it comes due. So then it becomes your job to think to yourself, okay, well, I know Clorox has, pick a number, $1 billion coming due next year. What's their plan for paying that back? Do they have, if they have the cash on hand, if they have $1 billion sitting up here in cash and total assets, well, then no problem, right? But they don't have $1 billion in cash. No company has $1 billion in cash. They got 1.8 in current assets. Well, take that back, that's where cash would be if they decided that they wanted to keep that much on hand. 367 million in cash. So that could be used to pay back some of that debt. And again, I was just kind of making up that repayment schedule, but you can see the breakout of cash, receivables, inventory, prepaid assets. We're gonna look at some ratios tonight that help us quickly assess how indebted a company is and how solvent. So we have current liabilities, current debt and capital. Long-term debt and capital, $2.7 billion, long-term debt, $2.4 billion. So that's typically gonna be the number that we focus on there, that 2.4 billion. When you go to look at the back of the 10K filing, you're gonna wanna find that $2.4 billion number and make some assessment, come to a conclusion, do a little analysis, what it's comprised of, how was that debt issued to the public, what interest rate are they paying on that debt? And then one of the numbers that we as analysts are particularly concerned with is something called the marginal interest rate. So you'll look to see how much yield, how much that debt is yielding today. I would just guess it's probably somewhere between 5 and 7%. That number, whatever their current yield is what they would have to pay to borrow an additional 100 million, 200 million, 300 million. So if their plan is to borrow more money at today's rates, it's very important that we understand what today's rates are so that we understand how much additional interest it's going to cost for these companies to refinance their debt. Okay, back to the slideshow. But credit can be used for operating activities, investing activities, financing activities. Those are the three major sections of the cash flow statement you'll all recall. So when we get new cash into the business, when we borrow money, that's a cash inflow. That cash is going to be used for one of those three purposes: operating, investing, financing. So if it's used for operating, what are operating expenses? Well, sales, marketing, general and administrative, that can be a little bit of a red flag. If we're having to finance operating expenses with borrowed money, operating expenses should be financed with the operations of the company. If we're having to finance operating expenses with borrowed money, it's generally an indication that the business is probably not very profitable. So that's another question that I want you all to find out whenever your company borrows money or whenever they last borrowed money. Find out what they used it for. If it's operations, ask some more questions. There are circumstances when using borrowed money for operating activities can be a good sign. One example of that would be expanding aggressively into a new geography. That represents opportunity. Another example of that might be expanding aggressively into a new vertical. So if you're expanding a new sales line, new product line, launching a new geography, launching a new vertical, those are all growth opportunities. And growth opportunities is exactly that, an opportunity. Investing activities, if we're using borrowed debt for investing activities, I want you to differentiate between capital expenditures that are growth in nature, just like those operating expenditures I laid out there, expansionary, versus capital expenditures that are maintenance in nature. So if we're Southwest Airlines and we're using borrowed money to keep all of our existing fleet running, that's a little bit of a problem. That's depreciation expense that flows through the income statement. Depreciation expense, again, should be covered by the operations of the company. We're having to use borrowed money just to keep our planes running, that's a little bit of a problem. On the other hand, if we're borrowing money so that we can buy 30 new planes to launch a new geography, an opportunity. And then you don't see this very often, but sometimes companies will borrow money for financing activities. Financing activities would be paying dividends, buying back their own stock. That's a little bit of a robbing Peter to pay Paul type of transaction. If I'm borrowing money from the bond market and then buying my own stock back with it. It could be an indication that the stock is very cheap and management has insights into just how good of a deal that is. You see company management teams do that quite a bit. And several years ago, when interest rates were 2%, 1%, they got negative there for a while. There was 2 years ago, there was, I forget what the number was. I think it was $2 trillion worth of debt globally that was trading at a negative interest rate. That doesn't happen anymore because interest rates have risen so significantly. But when the debt market was so easy to access, you saw companies doing this hand over fist. They were borrowing as much money as they could possibly borrow, using that to buy their own stock back. That takes float out of the market. When I say float, that just means there's fewer shares trading hands. So when there's fewer shares, the price of the share has to go up. It's just the simple math of that transaction. So through financing initiatives, management teams were, well, they were just being smart with the money. They were doing a good thing for their shareholders. They were doing a good thing for themselves. They were doing a good thing for all the owners of the stock. And we saw that take place quite a bit, a little bit less frequently today. So just be mindful of that when you see that debt used for financing activities. Slide number 8 is a good terminology slide. You might see this crop up in a multiple choice question. These are all different types of loans. So structured loans, revolving lines of credit, letters of credit, term loans, mortgages. Most of these can be issued by a bank. And the bank will have different features associated with this loan. So if it's a term loan, for example, that generally has a 3 to 5 to sometimes 10-year period associated with it. 10 years would be the longest. And there's a set principal and set interest rate associated with that. If it's a revolving line of credit, then a bank will issue your company access to a certain dollar amount. They'll charge you a fee for that. And then there'll be an interest rate associated if you choose to borrow from that line. It just kind of sits there as a reserve borrowing account until you choose to use it. And then it may or may not renew at the end of 12, 24, 36 months, whatever the terms happen to be. Structured can be just about any combination of those. Letters of credit are typically written by a bank to a third-party institution, and they guarantee a certain level of creditworthiness.
Mr. Kuchenberry, is it okay if I ask a question real quick?
Okay. Authors. Isaac, you got your hand up there. You got a question?
Are you able to hear me?
Okay, Isaac asked a while ago, how much time for the 40 questions on the exam? You get 2 hours. I'll try to be a little bit better about answering those Zoom questions at this time. I apologize. Okay, our authors take us through the process for credit analysis several times, and the bottom line takeaway for this is that it is exactly the same analysis that we do for equities. We have to do we have to come to a thorough understanding of the business, the economics, the strategy, the Porter's five forces, the whole SWOT exercise that we went through in module one. All of that's relevant. Because if we're a lending institution, if you work for a bank, or even if you're just a bondholder, what you're most concerned with is the likelihood that you're going to get paid back. How do you assess that likelihood? How you assess that likelihood is based entirely on the underlying economics and cash flow generating abilities of the company in question. So if we're talking about Apple or Microsoft or one of the big auto manufacturers, Tesla, those businesses are so strong and they're not very indebted. They don't already have a lot of debt on their balance sheets. So when you go to loan, I'll just use Apple. When you go to loan Apple money, what's the likelihood that you're going to get paid back? Well, it's extremely high. All you have to do is take one look at their balance sheet and compare that to how much cash they're generating on an annual basis and think, well, the likelihood I'm going to get paid back is almost 100%. That also happens to correlate with how much a particular company needs the money. And I'm sure you've all heard this. Only two, let's see, when was the last time the market for credit got really, really tight? It's tight today. You've all heard that the only people that can get a loan are the people who don't need a loan. So the more creditworthy you are, the less you need a loan. Apple doesn't need a loan. They don't need to borrow money. They can easily pay that back, which is why if they go to the bank's going to say, well, of course we'll loan you money, and we'll loan you money at very low rates because you're very creditworthy. Now that process gets a lot stickier the less creditworthy you become. So as your balance sheet starts to get a little bit more indebted, as your business model starts to become a little bit shakier, think about brand new companies, startups. They don't have a long history of operating. They don't have, if you look at Microsoft's cash flow, it's been billions and billions and billions of dollars for decades. Startups don't have it. So that process that we go through as credit analysts, really, well, we have to assess that chance of default, and that chance of default goes up significantly when we don't have a good history to key off of. So here's the process that we go through, and like I mentioned, step number one, evaluate the nature and purpose of the loan. What are they going to be using the money for? Step number two, assess the macro environment and economic conditions. Step number three, perform financial analysis. Step number four, perform prospective analysis. Prospective analysis just simply means that we're taking all of the information that we've been able to gather and applying that skill set so that we can make some estimate of what we think the cash flows are going to be in the future. Because it's nice to know how much cash flow Apple has generated in the past, but cash flows generated in the past are not going to pay us back in the future. What we really need to know is how much cash flow Apple's going to be generating in the future. If we know that with certainty, then we also know the likelihood we're going to get paid back with certainty, and it'll be much easier to make a decision on whether or not we loan it. Now, all that prior experience informs our decision making, but it's not exactly what we need. And step number four is module 11. We'll go deep into prospective analysis in module 11. Okay, Porter's five forces is on slide 15, and then just like with equity analysis, we'll do we'll take a look at the ratios, and we're going to look at several ratios tonight. We got a handful that address profitability and interest coverage, liquidity, and solvency. Okay, slide number 18, I wanted to pause on. We're looking at the loss given default. This is where credit analysis starts to get really interesting to me. Most of the bond world is pretty boring, especially when you're dealing with large Fortune 500 companies. They borrow billions of dollars, but they borrow that at a low interest rate, and the opportunity for investors is just that, very plain vanilla. But sometimes companies get themselves in trouble. You know, they borrow too much. And when that happens, that's our collective opportunity to put what we've learned in this class to work and dig into the fine print. And when you dig into the fine print, you typically find some features that were designed to keep the lenders, so us in this class, protected. Now, if you're dealing with a bank, so think about the lender or us as the bank in this instance. So the bank's gonna impose all kinds of rules, and one of the most common rules is collateral. So when you buy a house, you borrow money through a mortgage, and the mortgage uses the value of that real estate as collateral. So if you don't pay the mortgage, the bank gets the house. Well, that is a lot of protection for the bank. If you have a $300,000 house and you borrow 80% of that, well, you go broke or you don't pay that mortgage, the bank's gonna sell that house, and if they were smart about the way they lended the money, the value of that house is still gonna be worth more than the mortgage. So that's just one opportunity for lenders to protect themselves through collateral. You really have to dig into the prospectuses that are issued with each of these debt offerings, and those will be referenced in the 10K filing, or also you'll find those hosted on the Investor Relations website. Other levers that you'll see lenders use to protect themselves are called loan covenants. And loan covenants can be anything. Remember, I was listening to this book on tape, kind of chronicling the escapades of Motley Crue recently. And one of the rules that they had, I think it was Motley Crue. No, Bon Jovi. This was Bon Jovi. Well, anyway, one of the rules that David Lee Roth had when he would go on tour is that in his backstage room, he wanted a bowl full of green M&Ms. No brown M&Ms, no yellow M&Ms, no red M&Ms. He wanted green M&Ms. And did he do that because he was a rock star and he wanted to be a pain in everybody's butt? Maybe. But he claimed to do that because he knew that if the promoter took the time to read the fine print of the contract, which required a bowl of green M&Ms, and he walked in and he saw a bowl of green M&Ms, he knew that everything else in that contract had been followed to the letter. And he could take confidence that he could go out on stage and all his equipment would be set up properly and he could put on a good show. So that was the test that he snuck into the contract. That's what a covenant is. It's anything you want to put in a contract to keep the other party true to their word, so to speak.
I was gonna ask, do banks, still use the all asset debentures to, secure like a loan?
They can, yeah, absolutely. Yeah, and that'll be listed in the fine print of the loan. And they can use that, or they can use any other piece of collateral, and then think of that term loan covenant as just any rule that a bank wants to put into a contract to keep them safe. So lots of times you'll see banks use language in contracts or covenants that limit the amount of compensation an executive management team can take until they pay back that loan. Okay, that's got some teeth to it, right? If you're the CEO or the CFO of a company, you want to get yourself paid. So you're going to be in a hurry to pay back that loan, because if you pay yourself before you pay that loan back, then you've broken the covenant. And if you break those covenants, that typically gives the bank the opportunity to seize the collateral or something else that really hurts. So pay attention to those covenants, find out what they are. They'll be listed in the 10K, or sometimes there might be another document on the Investor Relations website. And if your company is even vaguely, obliquely flirting with the edges of those covenants, that's a big pink flag, if not a big red flag. So be mindful of that. Now, I started that little intro by saying that for the most part, the bond market is pretty bland, pretty plain vanilla, pretty boring. But when you're flirting with the edges of these covenants, sometimes those triggering events, if the company's about to break a covenant, can make a bond investor. It can make that transaction very, very interesting. Because those triggering events can turn that bond into an equity stake. So now all of a sudden, you don't own the debt of the company, you own the company. That could be the collateral. And that can be a very, very profitable transaction. And we're usually talking about an area of the market called distressed debt. I have a friend, he works in New York for a hedge fund. And this hedge fund specializes in distressed debt offerings. And they typically buy the debt of companies that are very, very close to, if not about to go into bankruptcy. So they're all bankruptcy attorneys. It's this hedge fund full of bankruptcy attorneys. And they know how to navigate the court system, and they know how to navigate bankruptcy filings, and they know how to draft and maneuver through a lot of these covenants that only come into consideration when a company gets in deep, deep trouble. And they know how to do it profitably. And they will, they'll throw up 500, 600, 700% returns on a single investment dozens of times a year.
Is there any time that banks would purposely put in like covenants where they're, where the company would break, like create a violation so they can then seize the collateral? Like, does that make sense? Like almost like they do it intentionally, like with the intention of, we know you're gonna break this, so we can.
So
take the
if,
collateral
so
on
let's,
purpose?
so let's role play this a little bit. You're the company, I'm the bank.
Right, so say,
And I want to put a very, very aggressive covenant in there so that if you even come close to I don't know, some threshold, I'm gonna seize all of your assets. That happens, and then it's your job as the business to say, no, those terms are just too. I'm gonna take my business down to another bank and try to get better terms. But sometimes businesses find themselves in such a tough spot. They have to take very harsh terms, and that's exactly what happens. I mean, if you're a business and you need the next $1 million to finance the next month's worth of payroll, or you're gonna have to let go hundreds and hundreds of your staff and your workers. And you're thinking, okay, I just need to finance this business for another month or another quarter, and I need 100 million. If I can get through the next quarter and I can land that contract from Apple or Qualcomm or Walmart or this big piece of business that I know is gonna come through, then I'm gonna be fine. But when that piece of business doesn't come through and your bank has hamstrung you with some very severe covenants, well, you don't own your business anymore. The bank owns your business. And that happens all the time. So it's our job to be able to see that coming. Because if we can see it coming and then make some conclusion about how likely it is, we can place our bets on either side of that transaction too.
do they make their contracts public where people can view them?
In the public markets, they do. Banks don't, always. Sometimes a company will make their agreements with a bank public as well as part of their common disclosures. But when the financing is public, that is exactly what it sounds like. It's available to the public, and all the strings attached to those debt instruments are available to the public to sift through and take advantage of. Okay, credit limits, trade creditors, banks, kind of touched on all of that. Talked about collateral, bankruptcy laws, give those slides some attention before the exam. repayment terms, pretty simple stuff here. The longer a loan is, the longer the terms are, the greater the chance of default, the greater the chance of the default, the greater the credit risk, the greater the credit risk, the higher the financing rate, the more we have to pay to borrow that money. So all of that is negotiable.
You go back to that one.
Sure.
Kind of for like a mortgage loan, wouldn't there be a greater chance of default if it was a 10-year mortgage instead of a 30-year mortgage? Cause you'd have to keep a higher income level up for those 10 years as opposed to lowering, you know.
Yeah, the payments are gonna be higher. It's typically,
But he says longer terms, greater chance of default, and I was thinking that it would be longer terms, less chance of default because you don't have to pay it all back so fast.
because the payment's lower.
Yeah.
Yeah, that's not I understand exactly where you're coming from. So if you make $100,000 a year and you finance a mortgage for the next 10 years, then your monthly payment might be 1,000, but if you finance it for 30 years, then your monthly payment's gonna be 600. Okay, well, 600 puts much less stress on your annual finances than 1,000 does. The bank is gonna control for that by how much money they allow you to borrow. And then they're gonna control for the length of the loan with the interest rate. So despite you and I having a common understanding of the financing associated with the 10-year versus 30-year, banks don't see it though. Banks see the 30-year loan as just more opportunity for stuff to go wrong. From natural disasters to COVID to another great thing. Any of those could cause you to lose your job and not be able to pay them. So generally speaking, they'll use an assessment of your cash flow to set the amount they're willing to lend and the length of the term, along with your credit score to identify the cost of that debt or the interest rate associated with it. Good question. Okay, slide 22 gives us types of covenants. There's 3 common types of covenants. And these are very, very broad. I guess just 3 bullet points here. The top one requires borrowers to take certain actions, or I gave an example of not taking a certain action, like not paying themselves or not issuing a dividend. Those that restrict the borrower from taking certain actions, I guess that's the second one. And those that require a borrower to maintain specific financial conditions. That third one is most common. We're gonna talk about ratios here in a moment, and a lot of these ratios that we're gonna be touching on specifically are cited by various covenants. So we'll loan you a little bit of money as long as you keep your return on equity above 6%. And then you have to give us you have to give us financial statements every quarter that prove your return on equity is above 6%. Or you have to keep your solvency ratio above 1.2 times, something to that effect. And as long as you're operating your business so that those ratios give the bank some confidence in your cash flow generating ability, then you're fine. Okay. Analyst adjustments. We do this for the next 8 weeks. We're gonna take little pieces of the accounting and we're gonna ask ourselves, is that an accurate representation of the true underlying economics of the business? In this example, our authors give us Home Depot. It's very common for certain retailers to use a 52-week annual fiscal year. When you use a 52-week annual fiscal year, well, there's 365 days a week, and that's not perfectly divisible by 52 weeks. So every 4 or 5 years, you have a fiscal year with a 53rd week. Well, if you have 5 years with 52 weeks and 1 year with 53 weeks, the year with 53 weeks should show more revenues, all else equal. That's a pretty easy adjustment that we can make as analysts. When we want to keep everything apples to apples, we just go and subtract 1/53rd of the revenues and adjust the financials from revenues to expenses to earnings and so on and so forth. And our authors give us an example of that here, I think, Target Corp. Who was in Target? So here's an example. these numbers are a little bit dated, but you can see Target Corp falls underneath this, this example. We're using the unadjusted numbers up top here. You can see total revenues, cost of sales. And then the adjusted numbers, looks like,
Looks like it's just 2018 that's changed. Wait, no. Your average change. I guess not the change.
yeah, let's see, so 17 is the same. Okay, 18 changed. So it looks like in 18, they adjusted the numbers down, so that's probably 52 weeks worth of revenues at 71. And then 19 is the same. So the authors are giving us the adjustment there, and then you can see the year over year percentage numbers are also a little bit higher, a little bit lower. So when you're doing your trend analysis, just wanted to people might want to be mindful of that. And there's a good chance that you'll be able to find analyst reports either through the ProQuest database or Bloomberg that have already done this for you. So your job is to know that it does skew their reported numbers. You might have to answer a question about that on the exam or know how to address that in your research report. But then you don't have to actually do it. Go find an analyst report that has done this on your behalf and just cite that directly. That's going to make your job a lot easier. Job number one, know what's going on in the financials and be able to explain it. Job number two, partner with good analysts that have done this on your behalf and cite it correctly in the research. Okay, let's look at some videos. Okay, profitability analysis. Return on equity. This was covered a little bit in module 3. You see net income over average stockholders' equity. We can break that down into its components. We can break that down into return on assets and financial leverage. And by analyzing each of these, which very commonly show up in these covenants that banks look at because they want to understand the company's returns. We can see Home Depot. We're looking at Home Depot here. Their return on equity for 2017, 18, and 19. If you look at that top line, went from 149% to nearly 300%, then to negative 5,000%. And Home Depot got caught up in that transaction that I was sharing a moment ago, where they borrow a bunch of money and buy back a bunch of stock. Okay, well, that's problematic when you're looking at return on equity, because when you buy back a bunch of stock, your equity account goes negative. And when your equity account goes negative, it makes these return on equity numbers nonsensical. You can't use a negative return on equity number. It's just silly. So our analysts recommend that we adjust those numbers. And we do that by looking at the treasury stock that Home Depot has on the balance sheet. We take that treasury stock number and we add it back to equity. When we add it back to equity, we get something that looks a lot more sensible. Now we have return on equity numbers that go from, call it 19 in 2017, 18.3 to 20.5 in 2019. Those are numbers that we can use to benchmark the operations of the business. Those are numbers we can use to benchmark the management team's success. Those are numbers we can use to share with the bank. We can do a lot of things with those numbers. Negative 5,000, can't do anything. Okay, let's look at return on operating assets. Return on operating assets breaks down similarly to return on equity. Only in this instance, we're using something called NOPAT, net operating profit after tax. We're going to divide that by our average net operating assets. And again, we can set that equal to NOPAT over sales, which is basically your sales profit margin, times sales over average net operating assets, which is basically your asset turnover. So the more profit we have, the more turnover we have in those assets, the higher our return on net operating assets. All of these ratios should be compared to your company's peer group. So how does Home Depot compare to Lowe's? I can't think of another publicly traded peer from Home Depot, so that's probably pretty simple, just compared to Lowe's. And time series analysis. So 3 years is not sufficient. You need to be looking at these numbers going back, hopefully 10 years. 10 years is a full market cycle. So you get a bear market, a bull market, an economic expansion, and an economic recession. You want to be able to understand what those ratios look like during a recessionary period. Because Home Depot's ratios are going to fluctuate wildly during a recession. Because what happens to home building? Dries up. So mortgage rates are now averaging 7% across the country. So that means that the number of new homes that are being built today is much smaller than what it might have been 2 years ago. So when new home building dries up, what increases? Well, home renovation increases. Home renovation is great for home. So that's gonna bring good things for their margin. And when it cycles the other way, you'll see their margin ebb and flow, just like you would expect. Okay, coverage analysis. What is coverage analysis and why would a bank be interested? Anybody want to help me out here? Anybody have, somebody works for a bank. I was going through my flashcards and saw that somebody was employed by a bank. Who was it? Did I get that one?
Maybe Isaac.
Maybe Isaac. Yeah, Isaac works for a bank. Since we're not gonna get him to come off on, we'll pick on Isaac until he comes off mute. So, Isaac works for a bank. He could tell us that, a bank might be interested in coverage ratios because they want to know how much cash flow is that company generating compared to what they owe us. So if they owe us an annual payment on that debt of, pick a number, $1 million, but their business is generating $100 million, is there any anxiety at the bank? No. That's a coverage ratio at its simplest. How much cash you're generated divided by how much cash you owe the bank. And the higher that number, the happier the bank is. And we can measure that in a variety of different ways. So times interest earned is exactly what it sounds like. We're going to take the earnings of the company and figure out how many times greater than what we owe the bank that number is. EBITDA coverage, cash from operations to total debt. Let's look at a couple of these. Times interest earned ratio shows earnings before interest and tax. So if you look at the income statement, we always put down to operating earnings. So operating earnings is what, generally speaking, we get from our day-to-day widget manufacturing. Operating earnings will then show up on the income statement, and from that we'll subtract interest and taxes. So EBIT, earnings before interest and taxes, you can think of that as operating earnings. We're going to divide that by interest expense to get this number here. 14.5, I think we're looking at Home Depot still. You all are the bank, you're the bankers. You just calculated a times interest earned ratio for Home Depot of 14.5. How does that make you feel? Yeah, I'd feel pretty good about that. Last year, Home Depot earned $15 billion and they owe us $1 billion. That means that their earnings could fall by $14 billion before we really have to get nervous about them paying us back. That gives us a pretty healthy margin of safety. So yeah, we feel good about that.
What's a bad number? Like where are we towing the line at when it's?
That's an outstanding question. And you would begin to assess that through historical analysis.
Okay.
So what I would want to know is, okay, they're at 15 billion today. If I look back at the last recessionary period, what did their earnings fall? I would guess it's probably somewhere between 30 and 50%. For a company like Home Depot, a cyclical company, that would not be out of the realm of what I would call normal or reasonable for earnings to fluctuate somewhere between 30 and 50%. Now, for other companies, during recessionary periods, especially if it's a deep recession like the Great Financial Crisis, well, you're going to see their earnings go negative. That happened to 80% of the United States. 80% of the companies that trade in the Fortune 500 went negative in the Great Financial Crisis. So all of a sudden, No, absolutely not. If this number's negative, well, that's a problem. So now, in addition to this ratio, you need to be looking at other ratios, which that'll be the next slide coming up, which show you how much cash a company has relative to the amount of debt that they have. Because if they can't pay you from cash flow, they need to be able to pay you from the cash on their books or something else, maybe total assets. So the analysis gets a little bit more complicated. So we just looked at EBIT coverage. Here's another ratio that would help to answer the question you asked. EBITDA coverage ratio. The difference between EBIT and EBITDA is depreciation and amortization. So now we have the same term in the numerator, EBIT, earnings before interest and tax. And we're gonna add back depreciation and amortization. The denominator stays the same, interest expense gross. What's the difference between those two numbers? Obviously depreciation and amortization, but why do we add those back? What insights do we glean from EBITDA that we can't glean from EBIT?
Depreciation is a fictionary cost, it's not, you can't, it's not money going out, it's just in the books.
Yeah, you're on the right track there. The terminology for that is a non-cash expense. So it shows up on the income statement as an expense, but we don't ever, I mean, there's no cash going out the door. I don't have any cash leaving the business when we record that expense against income. So the bank is interested in this number and they'll reference EBITDA, add back non-cash expenses, because then they get a better idea of what their cash coverage ratio is. Now, we could go back and forth a little bit on whether or not that's a fictional expense, because if you look at the business over a long run period, well, we all know those capital expenditures have to be paid for because you have to maintain your property, plant, and equipment. If you don't maintain your property, plant, and equipment, it's gonna decay on you and you're not gonna be able to use it in your businesses anymore. So a certain amount of depreciation is an honest expense against the maintenance that it takes to keep those going. But practically speaking, there's a lot of fudge factor that goes into that because you can delay those capital expenses, those maintenance expenses, that depreciation for years sometimes. That's another very important point for us all to key off of when we're analyzing these businesses is how disciplined companies are being about maintaining that property, plant, equipment. Because if you want to play that little game of follow the penny, if you're trying to get yourself paid, pad your earnings, make this year look good at the expense of next year or the year after that, you start delaying your capital expenditures. So I've been listening to way too much sports talk radio because it's Super Bowl week. So the analogy I would make there is if you're delaying your capital expenditures, that's the same thing as trading your future draft picks for players today. You're sacrificing the future of your team for income today. Okay, this is a great graphic, only because I want everybody in this class to have similar charts for all of these ratios for the companies that you're looking at. And graphically, it just kind of helps you identify a trend line. And those trend lines help you identify outliers. And outliers are where we learn the most about any business that we're studying. You know, how do they perform in challenging periods of time? Or 2023 was an off year, why? And how do we explain that? And does it create opportunity or does it create risk? Coverage ratios. So we're going to look at cash flow from operations relative to short and long-term debt, basically total debt. That's another leverage ratio, we call that. Free operating cash flow to total debt. Same numerator, less capital expenditures. And again, capital expenditures can be delayed at management's discretion. Because they can be delayed at management's discretion, we can factor them out of the numerator to give us additional insights, divided by short-term and long-term debt. And basically, we're just looking at half a dozen different ways to measure the solvency, measure the liquidity, and to measure the cash flow generating ability relative to interest that a company may possess. Current ratio. So many of you in here have full-time jobs. Thank you for making time for me in this class after those jobs. And if you do, you have a paycheck. Now, if you are cashing a paycheck regularly or hope to in the future, then this current ratio may be of interest to you because it's a measure of how likely you are to get paid next week or the week after that or whenever your paycheck comes. So find out what the current, if you work for a publicly traded company, find out what the current ratio is. What's their current assets over current liabilities? And then look next at something called the quick ratio. Find out what their cash plus marketable securities plus accounts receivable is relative to their current liabilities. And then if you wanted to be more aggressive with it, you could even just look at the straight cash ratio. Compare cash to what their total payroll is going to be in 2 weeks. Hopefully they have enough cash to get you paid. I have run across many companies in the past where both of these ratios were negatively trending. And if you're the type of heads up employee that's been through this class, hopefully you'll identify that trend line as being something that you should be very, very concerned with before your manager calls you into his or her office for a difficult conversation. And early on in my career, we're going back to the 90s here, I worked for Sprint. And it was actually a really fun time to work for Sprint. We were getting ready to put, when I worked there, we were getting ready to put the internet on the phone, if you can imagine. It was the coolest project that you could ever hope to work on, because it's just mind-blowing that we could put the internet on the phone. And that was the heyday, but then the telecom industry quickly consolidated, merged, got hyper competitive, and Sprint went through decades of just layoff after layoff after layoff, and it became a very challenging place to work. And you could see these ratios. The trend analysis of these ratios was not good. You could kind of see the handwriting on the wall. And when you see something like that, you know, you might be wise to start looking for another home. We're almost at time. Let's see, Isaac has another question here. My main question was about if financing through credit is a red flag or green flag due to potential buybacks. Could be either. That's a very difficult question to ask. You really have to look at it in a more holistic manner. Talking, I don't think it works on the chat. That might be my problem. I didn't try to take you off mute. I have tried talking a few times and it didn't work. Okay, well, keep trying. Appreciate it. You get credit for being on the line, man. I think that's about it, gang, and we are about at time. Let me look at my notes. In learning objective number 4, this is a great slide. Regardless, be able to come back to it. This takes you through the analyst grades. When you buy debt in the publicly traded market, it's going to have a grade associated with it. That grade tells you what the credit worthiness of the borrower is. As these grades go up or down, you're going to see the interest rate associated with those also go up or down. So if your company is anywhere near this green line, your company has a debt rating of Ba3 by Moody's, BBB- by S&P, or BBB- by Fitch, be wary of that. Because if they get downgraded again, they're going to move from a category of borrowers that we call investment grade to another category of borrowers that we call non-investment grade. Used to be called junk, but they rebranded it and now it's high yield. High yield sounds great. Everybody wants a high yield. Nobody wants junk. It was a piece of marketing genius, but it's the exact same thing. And the risk associated with it is still the exact same thing. So be wary of that. And you'll kind of see here another good chart that the authors give us are the solvency and coverage ratios typically associated with companies that have a AAA credit rating all the way down to a CCC credit rating. So you might not know whether or not your company's about to get downgraded, but you do know what their ratios are, and if their ratios are down here around BAA. Well, that's your little pink flag, that the regulators might be looking at your business through a skeptical lens. Okay, that's it for tonight. I'll get that test posted. I'll send out an announcement. Take it anytime in the next couple weeks. Reach out to me with questions. We'll be here on ground again for another lecture next Tuesday night. See you then. Oh. Thank you. Well, and all, exactly, I can break that down for you in a couple pieces. One, read it, because it's most. Yeah. So, to read it, what I'm primarily interested in is how you're managing. And salaries will be interested in, they'll be listed in there, but that's not the juicy part. The juicy part is their incentive. And it's technical. It's gonna require some work to really sift out what it is that they're using to incentivize these management teams. So spend some time with it and then just, that's all it's telling them. I want you to be able to understand that if they're buying stock back, that's gonna increase the earnings per share. And if they get paid based on earnings per share, then that transaction might not be an earnest transaction. That might be the more for the benefit of the management team than it is the shareholders.
Okay. I'll, thank you, I appreciate it.
Yeah, yeah, absolutely. Thank you. Karen?
Yes, Karen.
Nice to meet you.
Next to meet you, sir.
Procter and Gamble. Okay, I might have to ask you again. And give me your name again. Rajnit. Got you in here somewhere. You are P&G.
Yeah.
Oh, did I pass you? Oh, there we go. P&G. All right, thank you, sir.
Thank you, sir.
Did you tell us about those notes doing first files?
Yeah,
I added that for Bill.
no problem. It's in the syllabus. Just get me a bill card with everything.
Okay, and I also missed the speech you must have given about the what's it called, proxy analysis,
Oh, yeah.
and you said I could have more time on it last time we talked, which was 2 weeks ago, but I didn't really know what I was doing at all.
Well,
I just guess I don't really understand what I'm looking at, and I couldn't find a lecture where you talk about it. I tried to sit through them. Couldn't really understand, but I just don't understand when I'm on the proxy what I'm like. I did Johnson.
oh, great.
My bad.
Did you find the proxy?
Yeah,
Okay.
well, I just don't understand, because, you know, up here. You know, I guess I'm not necessarily understanding what you want to see out of an analysis of this.
I can break it down for you. 3 steps. And it's step number 1. Most of the people that take this class haven't read a proxy and they're fast. The proxy statement is, in my opinion, where you get all the best information. So step number 1 was, I want everybody to be able to find a proxy, recognize what it is, and read one. So just read. Step number 2 is to identify the information that we're primarily concerned about, which is always detailed in the proxy. How does your management team get paid? Now, their salaries are listed, so this is what they get paid, probably $1 million helps is typical salary of the CEO. But that's the boring part. So tell me that, but then also tell me what their incentive compensation package is and what it's linked to. That's the whole thing. If you can do that, you're good.
And then the other part was corporate governance.
Well, so. So don't pay, I'm not gonna tell you not to pay attention to it, but if,
So the only part I really found on here that, you know, completely said corporate governance was the highlights, and I'm guessing that's not what you want in the story, which is kind of.
yeah, so because I want you to read it, only pay attention to the corporate governance if anything really stands out. For a company like Johnson and Johnson, that's all probably gonna be for the material that was drafted by their attorneys, and I doubt there's anything interesting. But sometimes.
We're really looking at what the shareholders and the management are gonna get out of this.
Yeah. So, yes to your question,
Is there?
as you read it, the reason that corporate governance is in there is sometimes you will find in the conflicts of interest